The Nasdaq Covered Call ETF, the QYLD, is one of the most popular dividend funds with almost $8 billion in assets from millions of investors. And I'm about to piss off every single one of them. Well, the QYLD with its 11.9% dividend might be right for a very specific type of investor, which I'll reveal later who that is. There are two fatal flaws in this fund that virtually guarantees you lose money. In fact, for most investors, I found 5 monthly dividend stocks that beat it hands down, including one with a 15.7% annual total return. But I'll admit, it is easy to see why the QYLD is so popular. It pays one of the highest dividend yields out there. Put $10,000 in the fund and it's going to put cash in your pocket every single month, even if that amount rises and falls. You'll also see those checks hit your account every month, which is hugely motivating. Watching that cash flow like you're some kind of TikTok star. Now, it's not that the QYLD is a bad fund, but it is losing your money compared to the monthly dividend stocks I'm going to show you next. In fact, the QYLD returned at just 6.8% a year over the last 5 years. Yes, even with the 12% dividend, it only returned 6.8% because that share price dropped so much, and it's hugely underperformed the stocks it holds. I want to get into our list of monthly dividend stocks to buy instead, with an average 11% dividend yield and 66% 5-year return, but stick around and I'll explain how the QYLD works, the only investor type that should buy it, and its fatal flaws that lose your money. First up is Stellus Capital Investment, ticker SCM, with its 11.3% yield, very close to that QYLD, but with a few more factors in its favor. Stellus is a business development corporation, a BDC, a special type of company that you're going to see in a lot of these monthly dividend payers. These companies make loans to small and mid-sized businesses, and if they pass through almost all of that income to investors, they pay no federal income taxes. Stellus has nearly all, 97% of its loans in first lien or senior secured debt status, which means it gets paid first even if the company defaults. Almost all the portfolio, 98%, is in floating rate, so all in all, this is one of the safer BDC strategies you're going to find. The 11.9% weighted average portfolio yield isn't quite as high above the dividend yield as I'd like to see it, so you do have some problems with dividend sustainability there. That's because that weighted average portfolio yield is the average rate the company collects on its loans, and that compared to what the stock pays out as a dividend yield is a very important measure for that dividend safety and the growth, so you like to see that portfolio yield higher than the dividend. History does show the company's commitment to cash flow return though, with over $15 per share paid out in dividends since the 2012 IPO, even if the share price has slipped a little. We see that Stellus has managed to grow the dividend by 17% over the last 5 years, along with special dividends paid out, and the share price has produced a 68% total return over the period, about double the total return on QYLD. We're just getting started on our monthly dividend list, but I think most investors see that 12% yield on the QYLD and get dollar signs in their eyes. They jump in and buy shares without really understanding how the fund works and the risks to their money. The fund uses a covered call strategy on the Nasdaq 100 index. That's the 100 largest companies in the tech-heavy Nasdaq. So what it's doing here, it's buying those 100 stocks in this index, mostly those large technology companies, and then it's selling call options against them. The call options give an investor the right to buy a stock at a certain price up to a certain date. And for that right, they pay the other investor a premium upfront. For example, if I own shares of NVIDIA, but we're worried that it might come down from this current $900 share price, or if I just wanted to create a cash flow from a non-dividend paying stock, I could sell a call option to another investor. And if you look at the stocks in the fund, it's a who's who of big tech companies, with more than $500 million in shares of Apple alone, and along with Amazon and Microsoft. But if you scroll down, you see it's not all these tech stocks. You've also got shares of Costco, T-Mobile, and Pepsi as well, because they're in that Nasdaq 100 index. And what you don't see here, though you can if you go to the fund's holdings on their website and then scroll down, is the covered call strategy. So what it's selling to offset that risk and generate cash. We see this going to the fund's website and clicking to download all holdings. Here we see all 102 stocks held in the fund and the market value, all the way from 731 million in shares of Microsoft to 6.5 million in shares of SiriusXM for a total fund assets just over 8.5 billion. But here it's the last two lines that we see is a covered call strategy. The fund has sold calls and other investments against the Nasdaq index expiring in a month, that June 21 expiration, for a market value of $261 million, which is about 3% of the total fund assets. There are a few things that are important there that help you understand this strategy, where the risks are, and those fatal flaws in the QYLD. First, the fund is selling those calls against about 3% of the stocks each month, enough to produce the cash flow needed to pay out that 12% annualized dividend yield and any investor redemptions over the period. The cost of selling those calls every month is going to be a drag on the performance, though it's fairly small. Also, though, just using that covered call strategy means if the stocks in the Nasdaq do jump higher in 1 month, the fund is going to miss out on some of that because it's sold another investor the right to buy those shares for that cheap price. That's why you saw the QYLD underperform the Nasdaq tech stocks by so much over the last 5 years. The biggest problem, though, especially for investors living off their dividends, is that inconsistency and the decline in cash flow. I graphed the monthly cash flow you would have received investing $10,000 in shares of QYLD at its inception 10 years ago. At first, it was a respectable $100 a month, but fell to as low as $40 in 2017 and has averaged just around $65 a month since last year, about 8% return on your initial investment. Whenever I talk about the downsides to this fund, I do get a lot of comments that investors don't have to worry about the falling stock price if they never plan on selling the stock, but it does ignore that very real danger that the dividend amount continually gets cut along with the stock price and your income keeps falling. Again, there is one way around this, and one type of investor that the QYLD is perfect for that I'll show you later, but for most people, keep an open mind here and just take a look at these other monthly dividend stocks. Back to our dividend list, and Main Street Capital, ticker MAIN, is probably my favorite monthly dividend payer, even on that lower 8.3% yield. Main Street isn't the highest paying dividend, but it is the most consistent and the most dependable I've found. The dividend hasn't been cut in the last 5 years, and while it hasn't grown much, there have been enough special dividends to grow that total cash flow, and the total return of 74% is 11.7% annually, so a dividend yield plus that price return. As a business development corporation, again, Main specializes in loans and equity investments into mid-sized businesses. The company had 182 portfolio investments as of the first quarter, with the largest representing just 3% of total fair value, so a hit to any of these investments isn't going to hurt the shares that much. A big part of why Main has been one of my favorite monthly dividend stocks is that yield it collects on loans is so much higher than the dividend yield, with an average yield on its portfolio over 12%. It's collecting more than enough to pay the 8% dividend and then reinvest in the business for growth. That not only means dividend sustainability, but also a stock price that's going to return higher over time. Now here I have to admit, Ellington Financial, ticker EFC, is probably my least favorite of the list, but can still be a good stock and a solid 13% dividend yield, even higher than the QYLD. Ellington is another BDC here, and you can see I've highlighted the average yield on loans for its credit and agency segments. Credit loans are 76% of the portfolio, but at just under 11%, they don't cover that dividend yield. The rate on agency loans is even lower, though the company can use some leverage to meet that dividend payment without a cut. The dividend here has been increasing since 2020, and the shares have actually produced an 18% total return over the last 5 years, so despite not being as safe as the others on the list, it's still a good performer here. We've still got 2 more monthly dividend stocks that I think are a better fit for investors than the QYLD, one with a 108% total return. But I'm not saying that everyone should abandon the covered call ETF. In fact, with all its flaws, the QYLD does still serve a purpose for a very specific type of investor. That's because while the ETF doesn't give you that consistency that most retirees living off their dividend needs, it does produce a fairly good yield when you first buy it. For example, if you were to buy shares now around $17.50 each and get that 11.9% dividend yield, even if the dividend continues to follow the share price lower, you're still going to keep collecting that cash flow. And here, where that falling stock price actually becomes a benefit is for investors that need a capital loss to offset gains in their other stocks to lower their taxes. So we start to build an image of an investor, maybe a retired investor living off that cash flow, but still needing to sell some stocks to supplement their income and slowly selling shares of the QYLD to offset their taxes owed in the rest of their portfolio. Now, that's still going to mean it's not going to be right for many investors, but what do you think? I want to get your opinion on this. For all the pros and cons of the covered call ETF we've seen, let me know in the comments, what type of investors do you think should still buy the fund? Horizon Technology Finance, ticker HRZN, with its 11.4% dividend, is my favorite monthly payer for upside price potential on its venture capital strategy. Horizon makes secured loans to venture and private equity-backed companies in the life sciences and technology industries a $26 billion addressable market. It's a market that's taken a hit over the last few years with the venture capital crash, but as a former venture capital analyst, folks, I can tell you there is no better market for growth than technology, life sciences, and healthcare tech for a business development corporation. The portfolio of loans is well diversified by sector, geography, and company stage. You would expect most of the portfolio to be in that Silicon Valley West Coast area, here with 41% of loans, but is also nearly 2/3 in companies elsewhere in the Midwest and East Coast. The portfolio is diversified across company stage and sector, and all these are going to be those fast-growing startups backed by venture capital and, again, a great niche in healthcare and technology. So besides that high yield you get with the typical business development corporation, here I think you get a little bit of that growth stock as well. The average yield on portfolio debt for Horizon is 16.8%. Well above the 12% dividend yield, one of the strongest spreads I've seen in a BDC stock. The company has grown its dividend by 10% over the last 5 years, growing the dividend from 10 cents to 11 cents a share along with special dividends, and has produced a 62% total return. I'm highlighting just 5 of the best monthly stocks for that constant cash flow in this video, but if you like getting paid every month from your stocks, there are a lot more monthly payers to check out, so I'm going to link to this video in the corner and in the video description. A ranking of the top 20 monthly dividend stocks ranked for consistency, yield, and returns. PennantPark Investment, ticker PNNT, has made a lot of these monthly dividend lists lately, with its 11.6% yield and great price return. PennantPark is broadly focused across the capital structure compared to similar BDCs. While 58% of the debt here is first lien secured, it has a little riskier portfolio with 22% equity and 13% subordinated debt. That additional risk feeds into the higher dividend yield and will generally mean a higher price return when times are good. PNNT hasn't been as consistent with its dividend growth as I'd like to see though, having cut its dividends several times, but that's typical in most BDCs where the payout depends on each quarter's volatile earnings. Along with the higher yield though, this is one to watch, producing a 108% total return over the last 5 years. Want your dividend stocks to pay your bills? Then you need to know which monthly dividend payers will produce the best cash flow and return. Click on the video to the right for a complete ranking of 20 monthly dividend stocks and know you're buying the best. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.